Friends, the topic of today's podcast is the road ahead in 2020. This year would have been perplexing to individual investors and professional managers alike, given that most portfolios have not really performed while the index has shown quite a stellar performance. But if you take performance over a period of time, it is not unusual to have these stellar years in the index. What is unusual is this kind of performance has happened at a time when the economy is slowing, when sentiment is soft, and when we are not seeing a quick change in the economic numbers. Ahead of a prolonged phase of economic recovery, the performance in the Sensex has surprised all of us. But there are clear pointers about the future, and those pointers come from the nature of performance. Whenever we have had skewed performance, few companies contributing to most of the returns, such performance is not easily repeatable. Either the performance has to acquire a broad-based character sooner than later, or we will lose that performance. Now, I am not going to make a forecast about what will happen to the index, but it is fair to presume that those companies which have performed in the index would find it very difficult to ensure that the index performs one more year. Something else has to take that role. Some other companies have to fill that slot and deliver. What remains to be seen is if these companies which have done a stellar job in the Sensex or the Nifty will be able to hold on to their gains in the coming phase. That's open to interpretation. So, in the event of these companies holding on, then it is natural that the indices will continue to rise if the other parts of their indices perform. On the contrary, if they lose a little bit of value and others gain, then it could well be a sum of negatives and positives, which may not be very positive. This remains to be seen. But there is something which I can clearly see in the broader market. One thing is that the growth is not going to come back so soon. So, we are going to have 3-4 quarters of grinding. Therefore, growth cannot really drive our markets now for the next 1 year. So, what can drive the markets? I think that the principal driver of markets can only be reform, and so the ball is squarely in the court of those who have the power to reform, which is government. If we believe that reform is going to happen at a pace which will be dramatic, then we are going to see newer themes coming out of our expectations of reforms. And if government follows up systematically and periodically and maybe even frequently as it is doing now, then the themes will gain wider acceptance sooner than we imagine. Which means that we are set to see the return of bottom-up stock picking again in those spaces where we see reform make an impact. If we see a sell-off of public sector units gaining further momentum and showing clear success, then those other companies which are likely to be sold or we perceive them as potential candidates will quickly get re-rated. On the contrary, if the government is going to give a stimulus package to some sectors and is continuously doing things which will benefit that sector, we are likely to see that companies which have been affected in that sector but are fundamentally very sound may again get a bump. So, even in the absence of growth, reform can potentially be a driver. There is always going to be a defensive trade in every economy that is slowing. That will happen parallelly. I expect that this defensive trade can shift from consumption to other areas. We have seen that happen in some places like insurance. We have seen it in some parts of the market. But we can see it in other parts of the market which have been beaten down and been underperformers in the last 2 years. That again remains to be seen. But in every market where growth is slowing and capital has to be deployed, the natural tendency is to go and search for more defensive trades where capital can be deployed. So it's quite clear that we are going to be in a phase of generating, validating, and investing based on expectations. Last year, right through 2019, we have not done that. We have instead succeeded at the index level mostly by re-rating. Whereas I would think that the next 1 year will be very different and would actually be a phase when we are going to buy companies on expectations rather than on the other type of investing. So this promises to be a very exciting phase. It's going to be very challenging too, and it's going to be very interesting because you also have a belief that index investing has made a very huge comeback in the last 1 year. It remains to be seen how index investing is going to play out in the next 1 year and how all of us, active managers, active investors, are going to recalibrate our investment approaches in a new era. Happy investing, and thank you very much.